Okay.
Yeah.
For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Investing in shares today can be your gateway to financial freedom. To participate in the stock market, you need to open a CDS and a trading account. Here's a quick guide to help you open these accounts. A CDS account. CDS or Central Depository System account is fully owned and operated by Bursa Malaysia Depository. It keeps a record of the ownership and movement of shares traded on Bursa Malaysia. Simply put, when you buy stocks, shares are credited to your CDS account, and when you sell stocks, they are debited from your CDS account. In addition to a CDS account, you also need to open a trading account with a broker. A trading account is used to place your buy or sell orders in the stock market. Let us show you how to open a CDS account and a trading account in 3 simple steps. Step 1. Access Bursa Malaysia website and choose from any of the licensed stockbrokers listed on the website to open an account. Step 2. Once you have identified your preferred stockbroker, bring along your identity card and your bank documents to the stockbroker's office for verification. Step 3. Look out for a confirmation notice from Bursa Malaysia in your mailbox in the next few days. This mail will provide you with all your account details which you will use every time you trade. If you are new to the market and would like to learn the fundamentals of stock investing, please visit www.bursamarketplace.com. That's it! With these 3 easy steps, you are ready to start investing in the stock market and move towards achieving your financial freedom. Open your CDS account and trading account today. Happy investing!
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company, LifeChamp. So this is Shen Chu. I'll be the moderator for this webinar that is titled 5 Notes for New Investors to Start Building an Investment Portfolio from Scratch. So today we're going to discuss how new investors can start building a portfolio from scratch. Yeah, and these are 5 key lessons that we can learn today. All right. So a disclaimer, as usual, whatever we present on this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any stocks. So whatever presented here is only for case studies only. Okay, so if you decide to make any investment decision, you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker today, and he is Ian Tai. So Ian Tai is a content producer on kclau.com, and he has written more than 100 articles on kclau.com. He's also a weekly webinar host and presenter there. And aside from that involvement, he's also a co-founder of dividendvault.com, whereby they manufactured savvy investors who can build dividend-based portfolios independently. Okay. Personally, he is a dividend investor and he primarily invests for dividend income. And his dividend yield a year is ranging about 2 to 8% a year. So that's our speaker breakdown. So without further ado, let me hand over the session to you, Ian. How are you, Ian?
Hey Shane, how are you doing? And once again, thank you so much for inviting me on the show. It's always a pleasure to do a webinar like this for some Malaysia, and as well as for yourself, your audience.
Good to have you back here on our Bursa webinar. I'm doing great.
Yep. And today I have actually prepared quite a lot of materials. So Shane, let's do this, right?
Sure, you may go ahead and share your slide.
Fantastic. Okay, I'm going to just click onto the share screen button. So you guys are now looking at my screen, I believe. All right. Yep. So today, although the topic is more for new investors, but actually if you have been a seasoned investor, right, maybe you can learn something, a thing or two from this webinar also lah. So I won't actually leave you out. But if today you are a new investor, so I'm going to just invite you into a journey where we are going to talk a little bit more about the mindset, the psychology, all right? What is the right expectation when it comes to building a stock portfolio from scratch? Okay, so this is actually the stuff that I'm very passionate about. And I hope that over this 1 hour session and 1.5 hour session, right, maybe we can actually just talk a little bit more about that kind of stuff, all right? And to do that, I'm going to start off by asking you a very simple question. So Shane, don't disappear. You'll be my co-presenter for today. All right?
All right. Roger that, boss.
No problem. So before I just impart what I've learned in the past, maybe I would like to start off this webinar session by learning a little bit about our audience, which is you today. So here's a question I would like to ask you guys. So perhaps you can actually type in the chat box, and Shane, maybe you can actually check with me the feedback from the audience. So I'm going to just throw you a question here, which is question number 1. What is the current size of your stock portfolio? So is it A, below $25,000, which means you may be a newbie investor today, or is it B, where your stock portfolio is currently worth between $25,000 to $49,000? So anything in between $25,000 to $50,000, type in B. And if you are in the C category, which is $50,000 to $99,000, which means you have some experiences in stock investing and you have actually built your portfolio to a certain stage, all right? Not yet 100,000, but you are going closer to that, then you just type in C. And if you are quite seasoned as an investor today, maybe you can type in D. Shane, so what's the demographic like for our audience today?
Of course, there are a mix of A, B, C, and D. Can you see the responses at the chat group? I think majority are A.
Majority are A.
Looks like more people have A.
Hey, there's one E. So E says
I saw C. I saw E also.
Okay, so if you're E, which means you're A, all right? Okay. Actually, I see mostly A, all right? But there's a mixture of B, C, and D. Okay, fair enough. That is thank you so much for your response. And now I'm going to ask you the next question, which is, so right now, right, regardless which category that you are at right now, A, B, C, or D. So the next question I would like to ask is this: what are your current expectations from your stock investments right now? Okay, so just now if you have typed in A, maybe you type in A and then you type in what exactly, how do you expect to gain from your stock investment? Okay, or what are your expectations for your own stock portfolio? So type in your answers, A, then your expectation. Or if you're in the B category, B, expectation, C, and likewise D. So maybe we can actually see the response. So I believe we can see some response over here. So Shane, would you like to read it out, or would I just go ahead and read out the?
I think, let me see. Some of them want to hedge against inflation. I think there are a couple of responses also on, hedge inflation, if not beat them. Okay. And some are, I think many are aiming for a certain degree of capital growth every year.
All right.
Okay, different target. And there are a few who focus on dividend. And also there are some who want to grow from A category to D category. Okay.
Yes, of course. So we actually look at, I mean to say, most of the responses I see, I'm actually learning from your response, from our audience here. So some of them are in the dividends category, all right? And some of them are aiming for, they actually put in a specific target of returns like 10%, 15%, some say 20 to 30%, all right? So I presume that, of course, because most dividend yields do not go beyond 20-30. So I presume that most likely these are all capital gains, all right? These are mostly those people who put in the what you call percentage, right? Maybe I am actually learning from you guys. Maybe you guys are wanting to gain in the form of capital gains or capital appreciation from a stock investment. Okay, so thank you so much for your response. All right. So basically today I have actually prepared 5 notes for new investors. But of course, if you are seasoned, then maybe you can actually join right in. So the first note that I would like to discuss with all of you guys is actually to actually talk about the right expectations. Okay. So I believe that all of us, including myself, when I'm new to stock investing, right, there's always a certain kind of expectation that I would like to expect from my venture into the stock market. But now, after years of investing, so I believe that right now, if I would like to pass down the maybe a message to all new investors, right? So the first thing that I would like to talk about is actually the expectation. All right. So it's very important to set the expectation, right? So Shane, don't go away. There are more questions, and maybe we can actually play along together with me. All right.
Okay.
Shane, you will be a very busy host today, because I'm gonna rope you in.
No problem. I just off my camera when I'm not needed.
Oh, you will always be needed.
Okay.
This session, right, you will be needed because I also see you as a very accomplished investor. So I believe that you should be part of the show, So
okay. All right. Go ahead.
Go ahead. So let's set the expectation, right? So basically, although this webinar, right, is memang for you guys, if let's say you are new to stock investing, and if you're in the A category, which means to say your current stock portfolio is from 0 to below 25,000. So this is most helpful for you. Doesn't mean that if you have anything above 25,000, it's not so helpful for you. Still helpful, all right? And for those of you who have been trying out stock trading, speculating, gambling in the stock market, right? And you've got burned, and then you want to improve on your financial results or your investment returns, right? Then I will say that this session will be an eye-opener for you, okay? And of course, most likely, very importantly, if you're in the ABC category, right, I'm very sure that you want to know how do you actually go on to the next step so that you can actually hit the 6-figure target when it comes to your stock portfolio. All right, so of course, the reason why I have Shane on the platform, right, is simply because I have prepared quite a number of questions, small quiz, all right? So this is going to be a very active learning kind of session, all right? So now for this part of the webinar, right, here's a favor that I would like to ask of you, all right, which is I'll be coming out with a series of questions. So when you look at the questions, right, please be very honest with yourself when it comes to answering these questions, okay? Just be honest, all right? So the first question is this. Type in the chat box if, let's say, you believe in this. Number 1, capital gains is the fastest way to profit from the stock market. So that means to say you believe that the big money is capital gains. Yes or no? Type in the chat box. And maybe Shane, you can help me to moderate the the response.
Let me review all responses first. Okay.
Yeah. So I'm just scrolling down. It looks like yes. Yes.
Okay.
Yes, no. No.
I think from the survey, right, looks like we have more yes than no.
Yes.
Probably 70-30 mix.
70-30 mix. Okay.
Looks like lah.
I believe that is actually quite a fair assessment. 70% believe that capital gains is actually the faster way, and some say no. All right. Of course, there's one unique answer where it says short-term wise, yes, long-term wise, no. Okay. So that's the most unique answer I have received from your audience. Now, next question. I expect my stocks to go up by 20%, 50%, or 100% or more in 1 or 2 years or less. That means after you buy the stock must increase in price. Can be 20, 50, 100% and more after you have purchased them. So if this is your expectation, if this is truly what you believe, type in yes. And if you have a different kind of expectation, just type in no and what's your expectation. All right. So go ahead, type in the chat box. Maybe Shane, we can learn from your audience. So
I think this is 60-40 kind of breakdown between yes and no.
60-40 breakdown. Okay,
Looks
so
like
just now we see a 70-30 breakdown. Now it's more like a 60-40 breakdown. Okay, so 60% of you guys still believe that that is actually the honest expectation. Okay, now the third question. I expect if I buy 10 stocks, at least 8 out of these 10 stocks that I purchased, right, should go up in stock prices after I have purchased them. So if that is what you expect, that means 80% of the time, right, after you buy, the stock must go up. If that is what you expect, type in yes. If let's say you say no, type in another kind of, you can type in no and you can elaborate a little bit why you don't expect so. All right, so Shane.
This is maybe 70-30 also.
70 say yes?
Yes, yeah.
All right, a lot of people say no, huh? Okay, so we kind of like have, it says, okay, so NKS says, hope yes, but no in reality. All right, so I believe that we have actually done with the quiz. So I'm going to just review. So right now, okay, in order to make this session more meaningful for you, right, personally. So just now, if you remember, you are, let's say you are A, B, C, or D, right? So let's say, for example, you are A, okay? And then you just recall back the answer. If you are the A type, and if let's say your answer to the 3 statements, right, is yes, yes, yes. So just take note of that first, all right? So just take note of your answers, okay? And right now I'm going to review the next slide, which is this. So personally, right, what I believe is this. If let's say you are new to the stock, if let's say you're new to the game of stock investing, and you honestly have that kind of expectation, you have 3 yeses, okay? You have 3 yeses for the questions that I've actually asked just now, all right? Which means to say you believe that capital gains is actually the fastest way to gain from the stock market. Number 2, you actually expect that after you have actually purchased your stock, it has to go up. And number 3, every 10 stock you buy, 8 of them, at least 8 of them, it must actually go up. If you have that kind of perspective or that kind of expectation, right, you are actually kind of like setting yourself up for a lot of for failure and disappointment, all right? So that is actually something that I believe you should be mindful of. But there's a reason why of such belief, okay? And let me just share with you why I believe that way, okay? So for me personally, right, I believe that investing, right, is so much relatable with sports, okay? And so I'm going to give you a scenario why I believe that if you are new and yet you expect these kind of expectations, very good chances that you might be disappointed. This is because let's say we are into sports, all right? So now we have this, we are now at the starting point of the BWF Indonesia Open Super 1000 series. Just now before the webinar, I have watched a game. So let's say, for example, imagine yourself today, you are a badminton coach under BAM, all right? And now you're coaching a badminton player who is ranked 50 in the world, all right? He's not the top player like Li Zijia right now. He's number 50. So let's say you have this player, whoever it is, he's ranked number 50 in the world right now. And let's say you get him into a tournament, badminton tournament, and his opponent, right, your player, his first opponent, right, is either Kento Momota or Victor Axelsen, all right? World number 1 Olympic champion. So the question is this, what will you tell him to expect? If your player who is ranked 50 in the world, one is gonna have a badminton match against the top players of the world, like Kento Momota and Victor Axelsen. So perhaps you can actually type in the chat box, what will you tell your player? What will you expect him to do on the court if your player is playing against that kind of play, that kind of world-class players? All right, so let's just see the response. So Joe says, good point, huh? Must learn to manage your expectation. All right. Ui says, go out and enjoy the game. So Shane, what will you say to this kind? What will you say if you are the coach?
Do your best, gain from experience.
Do your best and gain your experience, right? Try your best.
But of course, before the game, I will have sit down with them, discuss about strategy, and think about the game, what is the game plan before they play against them.
So everyone just say, try your best, try your best. Okay, one says create a miracle. All right. Nonisa says, all right, just do your best lah. All right. So that is exactly the thing. All right. Maybe from a coach point of view, maybe you don't expect him to win, right? Of course, we play to win, but then sometimes it's more like a testing ground. It's more like, okay, let's test out the game plan and all this kind of stuff, and let's just do our best. So that's what we hope for. All right. So it's actually the same case, So today, if let's say you are new to stock investing, right? Okay, I believe that there's a shift when it comes to expectations. Okay, you instead of focusing on the return so much, like the 10%, 20%, 30% capital gains, and all this kind of stuff, right? If let's say today you are a newbie, all right, I will suggest one thing: shift away from the returns for the time being. Instead, take this 1 or 2 years time, all right, and focus on this following stuff. Number 1, focus on learning. Number 2, focus on gaining experiences. Whether or not you've actually achieved that 10, 20%, or whether or not you did not, it's an experience by itself. Gain the experience, learn from it, all right? And the third one is this: you don't need to be too gung-ho when it comes to building a stock portfolio. You can always test out your strategy, test water, and build a prototype investment portfolio. Just like you ask you will actually test the game plan. You tell the player who is ranked number 50 in the world, just go out and play. All right, this is the battle plan. Okay, we just execute and see what happens. Testing, learning, gaining experiences, and then if let's say your player has achieved what he needs, has achieved your expectations, okay? Although he lose the game, but he did his job, all right? Count that as a small victory, all right? Very important, okay? So which means to say, this is actually the shift in focus that I would like to just share with you guys, especially if you're new to stock investing. Focus away from winning or losing the badminton match. Focus on learning and gaining experience. So that one is actually the first point that I would like to highlight to you guys, okay? Now let's move on to the second one, okay? So this is the second note that I would like to share with you guys. I would like to discuss with you guys, which is this one, okay? When it comes to building a stock portfolio, I do not know about you, Shane, all right? I go through the 5 phases. Maybe you can identify together with me, whether or not you go through the same phase or not. All right. I believe that, yes, I mean to say, for most investors, they tend to start off with nothing in their stock portfolio, from zero. But along the way, we journey along, right? And there are phases that we actually go through in order to learn, to grow, and to mature as an investor. So these are the 5 phases that I personally go through. Maybe Shane, after you listen to the 5 phases, you can chip in a bit, whether or not you did go through this kind of phase. All right. So this is what I've experienced when it comes to building a 6-figure stock portfolio. All right. And let's go through the phases. Now, before that, I just want to share with you guys about this mindset. Okay. Some people may actually expect this kind of thing. All right. So let's say the blue color word here, it says, for some people, they expect initial capital, maybe they save up $10,000. And then in an instant, what they expect from the stock market, right, is within months or within 1 or 2 years' time, they can turn their 10,000 ringgit, and then they suddenly become a person with a net worth of 100,000 in the stock market. Okay, so if you have that kind of mindset, you may have to change a little bit. Yeah, all right. I'm just suggesting you can change or you can keep your mindset okay. But usually, right, the journey will involve phases, and this is my phase. Okay, so this is the journey to building a 6-figure portfolio. So for me personally, I go through 5 phases. Okay, the first phase will be the mindset phase. The second phase will be the learning phase. The third phase will be the prototype phase. The fourth phase will be the optimization phase. This is where I optimize my portfolio. And finally, phase 5 is the expansion phase. Okay, so these are my 5 phases, but now I'm going to go through a little bit in depth about each and every single of these phases. Okay, so that you know there is a roadmap from where you are right now to hitting 6 figures. Okay, so let's talk about the first phase, which is the mindset phase. Okay, so the mindset phase, all right, is actually about this. So last time I used to think that stock investing, right? What I think about stock investing is not investing lah. Okay, what I think about stock investing was actually trading and gambling. All right, so that's why I thought that stock investing is very risky, because I thought that it's just about picking the right, somehow magically pick the right stock and then it just go up. That is what I used to think. And that is why I also don't dare to go into the stock market, simply because I thought it is like gambling. But the first phase, right, is where I have to change my thinking from a trader, from a speculator, to one that is more towards investing, which is about looking at businesses, looking at the fundamentals. All right, study how Warren Buffett actually manages his portfolio. Okay, instead of looking at the stock price all the time, now I look at businesses. All right, it is actually more focused into the business, the fundamental side, than the stock price. All right, so there is actually a shift when it comes to the mindset. So this is actually phase number 1, the mindset phase. Okay, now after I've gone through the mindset phase, the next phase will be the learning phase. So the learning phase involves 2 things for me. The first one is that I need to know how to identify good businesses from a pile of bad businesses. All right, so I need to know the differences. The good businesses that I prefer and I will invest, and the bad businesses that I will want to avoid. So in order to identify good businesses and bad businesses, I need to learn accounting. I need to learn how to interpret financial statements. I need to know how to interpret the income statement, balance sheet, and the cash flow statement, so that I can actually identify good businesses. So that is skill number 1, the learning phase. Skill number 2 for the learning phase is actually, after I have accumulated a pool of good businesses, right? How do I know whether these businesses are, these stocks, these businesses, how do I know whether or not they are undervalued, fairly valued, or overvalued? I can't be looking at stock prices, because stock prices doesn't tell us valuation. So I need to learn how to calculate valuation ratios in order to better understand the valuation of these stocks, whether or not they are cheap or expensive, undervalued or overpriced. Okay, so these are the two skills that I need to learn, all right, in the learning phase, so that I can avoid all the bad stocks that are expensive, and I can only focus on good businesses, and I only invest in them if they are cheap enough lah, and if they are undervalued. So this is actually phase number 2. Phase number 3 is this. Now, I've changed my mindset. I've picked up the skills, the 2 skills, accounting and valuation skills. The third step is to test water, build a prototype portfolio. So what do I mean by that? Prototype means to say we test water, which means to say if let's say you have $100,000 in cash today, you can use that to build a stock portfolio. But instead of using all of this to build a stock portfolio, we take a portion of it, maybe $10,000, maybe $20,000 to test out your system, to test out your strategy. So in order to do that, there are a few things that are involved. The first one is that we need a watch list. So I built a watch list, usually about, you can actually start off with 20 stocks, 20 businesses, make sure they are good. Then the second one is to build your own investment system or your own investment criteria. You want to know what are the businesses that you like to invest into, and you must also be comfortable with the valuation. All right, so you must have your own set of details, your own set of rules when it comes to identifying good businesses and as well as the valuation. All right. The third one is that what happened is that you need to actually start off with a small portfolio to actually test out your system. And then over here, we don't try to hit the 10-20%. We try to hit the small little gains first. Even if you are getting your first dividend income, celebrate the small success. All right. At least there's 1 or 2 trickles of cash return. Celebrate that. So that is what we can actually aim for when it comes to building a prototype. Then we come into the fourth phase. So what is the fourth phase? Fourth phase is actually like this. Phase number 4 is when after you build the prototype, right? Okay, it's like the player, you know, just now the player, world rank number 50, play against Momota. He may win, he may lose. After that, you go through a post-mortem. You want to identify his strength, what he did well in the match, and you also want to know what went wrong during the match. All right, what could he have done better in the badminton match? Yeah. So this is actually where you analyze your gains, your losses. Okay. Some you may do very well. Some you don't do so well. Analyze them. Okay. And then in this phase, right, what I did is I learned the mistakes, the things that I didn't do so well. What I did was I cash out. All right, all the mistakes that I made, cash it out, and then I convert them into winners. All right. So that means if I try a few stocks and then these are not working, cash it out, put it back, or pinda it, convert it into things that actually work very well for me. So that is actually the optimization phase, okay, which actually involves a little bit of reflection, learning, and converting losing stocks into winning stocks. And finally, after phase number 4, we can talk about expansion. So what do I mean by that? After you have built a prototype portfolio, you now know how to convert the losing stocks into winning stocks. But then along the way, you still make money, right? So this is actually when you can go in full force, and then you can actually start raking in you can actually start expanding your portfolio at a greater scale. Okay. So if you're at the $25,000 phase, you can actually start thinking about 50. And then if you're at the 50, you can start thinking about the 75. And from 75, you can hit 100,000. Okay. So you only expand this kind of portfolio, right, when you have a more refined investment plan, you have more experiences, and then you kind of like know your chances of success. Okay. You kind of like know where are the places you should be avoiding, and you know where to put your money so that you can actually enhance your returns. So this is actually the expansion phase. Okay. So it is actually at this stage, right? Expansion phase, right? This is where you get the best returns. Okay. Because you are kind of like experienced already. You kind of like know what to do already. So this is actually the 5 phases that I go through. So I'm going to just stop for a moment. Shane, these are my 5 phases lah. I know it's quite lengthy, my explanation, but what do you think?
Yeah, I
Phases.
think it's the natural growth of investors lah, to figure out what works for you. And then I think what is important for every investors is to know a few things. Number one, know what is your investment objective. Do you want to go to the market to create an income or to create wealth? So if you just want to create an income, then you use income generation strategy, like you do swing trading, So if you just want to create wealth, then you go for wealth creation strategy. Okay, then you can go for investment. So number 2 is, of course, know what is your risk appetite. What kind of understand yourself. Know what is your risk appetite. What kind of how much risk you can take, and then how much drawdown you can afford. So these are 2 things. And then also understand your own expectation. Okay, what is how much time you have to get the kind of return. Okay, so these are some of the things that we need to understand about ourselves before we get into the market. Of course, maybe for new investor, maybe we will struggle a bit in the market to find what works for me, because sometimes you may not know what you want in the market yet. Because when it comes to investing, a lot of new investor would of course want to get rich quick fast Everyone of us certainly have certain level of degree certain level of greed So of course if we can make 100% in 3 months, why we want to make 100% in 3 years, right? So we want to find a strategy to make 100% in 3 months instead of make 100% in 3 years. So we want to get rich quick in the market. But along the way, we will learn what works and what didn't work, and then we'll finally understand what is suitable for us. So I think for young investors, for new investors, it is important that we understand ourselves and then understand what works for us, what didn't work for us, what kind of risk we can take. Then finally, we find what works for us, then we focus on that. So I think many of the times is that, the ability to earn money in the stock market is works within our circle of competence. So if you make money beyond the circle of competence, right, the market has 1,000 ways to make the money back from you. So more importantly is expand your circle of competence so you are able to make more money from the stock market.
Okay, very well said. So Shane, just one additional question. I believe that you brought in a very good point, all right, which is new investor, right? Maybe because new, right? So maybe they may not. So just now you talk about investment objective, right? So technically speaking, knowing yourself, understanding the investment objective, which phase would you kind of like know yourself much better? Is it at phase 1 or is it more like phase 4, 5, stuff like that?
Yeah, I think it's through trial and error. Okay, but personally for me, of course, I started investing when I was 19 years old. Then I tried a lot of instruments, options trading. I was already buying and selling options. I was already selling options in the New York market when I was 21 years old. Okay, I write options, weekly options on the New York exchange. So when I was 21 years old, so I also tried forex trading, futures trading. So after you do a lot of trial and error, then you know what works for you, all right. So you know what kind of product you focus on, what kind of strategy you work on. For me, the kind of learnings after experimenting different products and probably stage 3 or stage 4, I guess.
All right. So as you can see, wow, Shane, you actually started so early, right, in your life, So
yeah, but I'm the moderator, you're the speaker, Not I am supposed to interview you, right?
True. But I mean to say, actually this session, right, can be conducted in, it can be very flavorful because my journey actually could be very different from yours. But I believe that there are some similarities that our audience can learn from, and as well as we can actually celebrate each other's differences that our audience can also embrace and also learn from both of us. All right. So regardless what, I believe that all of us go through phases when it comes to our investment journey. Nobody gets it right in the first phase, all right? So that is why, all right, if you are new today, unless you are I do not know lah, unless you are a total genius. All right. You know how to just take 10,000 and make it big in no time. But most of the population, if you're not that smart, what you will go through is that you'll go through the 5 phases. Okay. The mindset phase, the learning phase, prototype, optimization, and expansion. All right. So just now there's a question, right, from Edwin. How long does it take for you to go from phase 1 to phase 5? Actually, right, you can say the shortest amount of time could be 1 or 2 years, but I would say myself, right, so although I go from here to here in maybe 1 or 2 years time, but after you expand, right, you will have to actually go back to phase 1 because, all right, let me explain. When you're starting off, you start off with certain kind of mindset, all right? You will do certain things which is good and suitable for yourself when you're in the, let's say, 10,000, 20,000, 50,000 category. But what I can say is that after you hit the 50,000, 75,000, 100,000, and beyond that, right? And especially beyond the $100,000 mark, what you will do is that you will employ different mindset. You will employ a certain kind of strategy which is suitable for a portfolio size of that size, okay, which is the 6-figure portfolio. And of course, I believe that if you hit 200, 300, 500,000, or even $1 million, how you invest at that time, all right, the mindset and the skill set to manage that kind of portfolio will be very different if you are managing a 6-figure portfolio, okay? So do know that these 5 phases that I talk about, right, is a continuous learning cycle. It's a learning experience. It's a journey, all right? Because even though you graduate from phase 1 to phase 5, we'll go back from phase 5 to phase 1 all over again, and then we will start, and then here we go again. So that is actually my life. That is what I believe is to be the investment lifestyle. Is actually what I go through Phase 1 to phase 5, back to phase 1, and go back to phase 5, graduate again, go back to phase 1. So there is no ending to this There's no graduation you can say, all right? So make sure that you have an attitude of being passionate about learning. So if you're an investor, you have to be passionate about learning. It's as simple as that. You cannot just say, I want the money, but I don't want to learn. It doesn't work that way, okay? Because how you manage your $10,000 portfolio will be very different from how you manage something bigger in the future, all right? Take note of that. Now, when I say that, right, how many of you here kind of like say, hey, this is not what I signed up for, quite discouraging. Actually, I want the money, but I don't want to go through the 5 phases. Anyone actually feel that way? All right, so I hope that nobody actually feel that way. All right, so everyone is still quite passionate about learning, and everyone is still quite encouraged that this is actually quite doable. Okay, so I'm also actually quite encouraged. Hopefully nobody or none of you actually drop off. All right. Okay, with that, let's quickly move on to the next one, the next note, which is the key ingredients to build a 6-figure portfolio. Okay, so just now I talked about the phases. Now I'm going to talk about the ingredients that we need in each and every single of these phases. Okay, it's going to be very short because the 5 phases is very important. Now we just need to fill in the ingredients. Okay, so these are the ingredients that I believe that will be very helpful if you are going through these phases, okay? So let's say, for example, you are now A, all right? Just now you're in a category A, you're new to stock investing, all right? So what happened is that you're in the first phase, which is the mindset phase. So here, you can actually take out a piece of pen and your notebook or your pen, you can jot down the homework, all right? So these are the ingredients, which I believe will be very helpful for you when it comes to building a portfolio. If you're in the mindset phase, what you need to do is this, okay? You need to compare what you believe about stock investing is with the mindset, all right, that successful investors adopt. And you compare the difference. What you believe, what successful investor believe, compare the difference, all right? So if let's say you find that, hey, this successful investor like Warren Buffett, actually he thinks that way, and it's different from yours. Then you see which one you want to adopt. All right. So this is actually your homework, mindset phase. Okay. So you want to compare your beliefs with the successful ones, and then you adopt the successful ones if you think that they are better. That's the first one. The second one is the learning phase. So learning phase just focus on these two areas. The first one is accounting skills. The second one is valuation skills. Accounting skills, like the financial statement and all these things, is to tell you only one thing: help you to find good businesses and help you to avoid investing into bad businesses. That's all, right? Accounting skills is to find you good businesses and avoid you from buying shares of bad businesses. Valuation skills is to protect you from overpaying for a certain business. Valuation skill is just to help you to find the best deal in the market. So if you think that you can invest without accounting and valuation skills, you're in for a lot of trouble. All right. Make sure you have these two skills in your arsenal when it comes to building a portfolio. Very important. So no skill, don't talk about no. If let's say you got no skill, then don't really talk about returns. Okay. So like the badminton, all right. You need to know how to serve, how to smash. All right. How to do the net play. Focus on all these skills. Don't talk about beating Momota yet. Let's just talk about all this footwork, net play, smash. All right. Know how to do the lift. Then only we can talk about the game plan. All right. Now, let's talk about the game plan, which is the prototype. So the prototype here is to set up a system which is workable for you. All right. You need to have a system on how to identify the businesses that you want. All right. The valuation that you can accept, the capital that you are willing to test water, build a watch list, try. Okay. Just try, aim for small success. That is your homework. Aim for small success. It can be your first dividend income. It can be having, oh, you buy 10 stocks, all 10 stocks give you dividend. Very good already. Small success. And then take the dividends, right? You can reinvest back, or you can just buy yourself a chendol and have a celebration. Okay. If you can buy 10 stocks out of 10 stocks, all pay you dividend, right? That's something that a lot of investors can't even achieve. So you can actually, you deserve a pat in the back and a chendol, all right? That is actually the third phase. But then when it comes to optimization, this is actually where you kind of like look back at your system, you look at your own plan, and then you refine it so that you can increase your chances of success. That is optimization. And once you have done that and you test water again and it works very well for you, then you go with the expansion. Okay, and that is how you graduate. Okay, so these are the homework. These are the homework that you may want to do in order to build your portfolio. Now, let's move on to the next note, which is part number 4. Okay, so this is actually a very, very important lesson, okay, which is what to do if the price of our stocks fall after purchasing them. Okay, before I actually discuss further, right? Maybe you can actually type in the chat box. If let's say you buy a stock and then the stock price, right? The stock price of your stock actually dropped after you purchase, right? What will you do? So type in the chat box and let us know. Joe says hold.
Hold.
Ashley says hold. Okay, Ng Seng Hock says sell off. Oi says cry. That is actually expectation, you see. You expect it to go up, but it go down. So you cry more, but so you have to actually set in more. You have to actually set your expectation. Crystal Chia says buy more if confident. But the question is, where is your confidence? Abdul Rahim says stop loss. Edwin says manage the trade. Ji Ming says rebuy to lower costs. Okay. Average down. Naga Bistari. This one, very familiar name. Yep. Average down. All in. I already say a lot. Prototype, not all in, right? So prototype, test water first. All right. Cut loss if exceed my limit. So there's actually quite a mixture of answers from your audience that I've actually gathered. Okay, very well. So this is actually what most people do. Of course, most people kind of like are quite shocked when they say, sometimes I actually receive a feedback whereby they are quite shocked. Why my stock drop actually up? Why my stock actually drop after I purchased them? Very disappointed. Should I cut loss? Should I do this? Should I do that? But here is actually the thing that I would like to actually impart to you guys. All right, here are a few rules which I think will be very helpful if you are new to stock investing. All right, so this is the first rule. Rule number one, it doesn't matter what strategy you use. I don't care whether you are a trader, speculator, investor, gambler, whatever. Rule number one is, after you have purchased your stock, the stock price can go anywhere. It can go up, it can go down, it can go sideways. And all these things, right? Please take note, guys. Very normal. Normal, okay? And because it is normal, before you buy into a stock, you must anticipate what will you do when your stock price go up, what will you do when your stock price go down, and what will you do when your stock price goes sideways. A lot of investors, what they do is this. They buy a stock thinking that they will go up, but then if they go down, they never expect. Then they'll just say, what's wrong with my stock? All right. Then they start to say, then they start to find out every single news. Why this stock drop lah? Why lah? And then they say, what should I do? They only think, what should I do after they buy the stock? But for us in this webinar, the most important thing here is this. You have to think, what should you do before you buy the stock? Not after, it's before, right? Okay, so make sure you get that right. And when your stock price actually drop, it's normal. Relax, all right? It happens. It happens to everybody. Even the best of the best in the business, like Warren Buffett, Charlie Munger. In fact, recently Charlie Munger, he buy a stock, Alibaba, and then it dropped. It's normal. It's normal. It happens to him, all right? So if it happens to him, it happens to everybody. It's as simple as that, okay? Rule number two, if the stock you invested drop in price, are you willing to hold and own onto it for life? Now, this is actually, so I see a lot of response, all right? Some of them say average down, some of them say cut loss. So I'm actually re-asking the same question, all right? So for those of you who want to, give us some feedback, right? Maybe you can put in the chat box, see what we can learn from you guys here. So Marcus Chan says yes. Ng Seng Hock says no. Muhammad Amiru says depends on game plan. Ng Li Chin says yes. Song says yes. A lot says depends on the fundamental, Naga Bistavi says cut loss, says yes. Jeffrey says don't know. Okay.
Yeah, I think mainly it's depend on game plan.
Mainly I depend on game plan already.
Yeah.
Okay, so this is actually what happened to most people when it comes to buying a stock. All right, and I'm going to share a little bit about investors. Investors, how we actually see things. All right, how most fundamentalists actually see things when it comes to this. So for most people, they're only happy to buy a stock and to own it if, let's say, the stock price go up. So it's kind of like, it reminded me of Top Glove. When Top Glove actually go up, right? Wow, everyone is so happy to buy, everybody is so happy to hold, and all this kind of stuff, right? And then after that, Top Glove went from $28 and then stock split to $8, and then from $8 dropped until don't know how many dollars. Hey, what's the latest stock price of Top Glove? Maybe $2, I do not know. Then people are saying, oh yeah, should I cut loss? And all this kind of stuff. Most people, when they make their decision, they always make based on stock price movement, whether or not they should hold, they should sell off their stock. Everything is all about the price. For investors, true investors, it doesn't matter about the price. It's all about the business. If the business is good and they're happy with the valuation, they buy and they hold. It's as simple as that. Okay? Because why? We don't necessarily view investment in the form of stock price ups and downs. We only want to own good businesses, and we just don't want to overpay for them. And we just want to hold on to them as long as these businesses are well run, well managed, continue to grow, continue to pay dividends. Fantastic. Okay? So for us, we are less worried about stock price up or down. It's simply because we actually genuinely want to own the share lah. Because our ultimate objective is to own the shares and be a genuine shareholder of the company. We're not so much about trying to profit from the price difference of a stock. So if you have that kind of mindset from an investor's point of view, you kind of like have less worry lah. Your blood pressure should be very good lah. Okay, you should actually be able to sleep at night. All right. So if you actually focus on the business, so that is actually rule number 2. Think about it lah. All right, this one I already explained, so let's move on. Rule number 3 is this. This one I already said. Most people actually only think about what to do after purchasing stocks. So guys, right now it's very important. The next stock investment that you purchase, right? If you have a habit of thinking, if you have purchased a stock before, and then you think only what to do after that, right? The next stock investment, right? Please think what will you do first before you buy the stock, okay? So you can actually use this simple kotak, simple box, and then you just jot down your action plan. If the stock go up, what will you do? If the stock come down, what will you do? If the stock goes sideways, what will you do? So make sure you have this thing through first before you buy the stock. And finally, let's move on to note number 5 or part number 5, which is also quite related to note number 4. And the thing is about emotion. You see, money and emotion. Money is an emotional subject. All right. Some of us, we make decisions about money, including investments, based on emotion. All right. So the thing about investing, right? Why we actually talk about the 5 phases, right? It's simply because, all right, in this process, we also want to learn a lot about our own self, how we deal with our own emotions. All right. And it's always very important for us to give us a check. There's always a check and balance, always a reflection about our emotional state, which is very important for investors. Okay, because the better we handle our emotion, the better we can handle investments. Okay, so this emotional handling, right, is actually part of the investment. Is actually part of the investor's journey and the homework. It's a lifetime of homework. Okay, so this is very important. All right, so as I said, emotional handling is part of investment education. Okay, so now with that, right, let's start with a simple question. Maybe you can type in the chat box, list down the emotions that you will feel when you buy a stock as a new investor. So let's see what is your response. But maybe Shane, you can tell us, hey, how do you feel?
Yeah, I think.
Can you recall the time when you are first time investor and you buy a stock? How do you
first
feel?
few response is anxious, nervous. Okay, I think in this case, in the badminton context, need to quote Tan Boon Hong and say, "No, jangan kanchong." Okay.
Jangan kanchong, huh? Yes. But we still feel the kanchong.
Since you relate to badminton just now.
Yeah. It's always that feeling, There's butterflies. It's
I think they were a lot more excited. A lot of
excited.
people are excited.
One says sweating. Who says sweating? Eric Fu says sweating. Iqbal says afraid. Chin Jiayi says anxious.
When I bought my first stock, I also felt about the same thing. Yeah, finally, it's like, make our first click buy, right? A bit nervous.
Nervous,
Then a bit excited also, like you take a leap of faith, to invest in the company. But my first few investments are all investing, not for so much for trading. It was not through all the kind of strategy that we want to test. Then we figure out what works and what didn't work. So then the first few stock I bought is all for investment purpose.
Okay. So now, when's the last time you buy a stock, Shane? When's the last purchase that you make?
I think last week or 2 weeks ago.
2 weeks ago. How do you feel compared to your first time?
Yeah, of course, now is no feeling like that because got game plan, what to do if go up, like what you said, what to do if go down. Yeah, what is more important is make sure we invest in a good company.
Okay lah. So compared to the first time, now bo rasa already lah. Now lesser rasa lah. No, not much rasa already, right? Yeah. So actually, that is, you see, there's always a difference one. First time buy stock, and after many years later you buy stock, different one.
Yeah, there's also a different setting altogether because first time when I bought, right? So I only have like a couple of thousand, right? And so we all in the one stock lah. You get what I mean? So when you all in the one stock, of course you feel more emotionally because your money is at stake, right? And that is a risk. That is not a risk capital. That means it's something that you cannot afford to lose, because I was investing with my PTN money. Okay, so there's something that it is not a risk capital. So of course you have more emotion at stake, right? But now it's more about portfolio management, right? Now when I set aside a allocation to invest in stock, right? I make sure that the stocks, the allocation is not something that is too significant that it can affect us emotionally.
So actually you bring up a lot of very good points. So initially I also feel that way. That few $100 or the few $1,000 into that stock. Wow, it's like one heck of a big thing last time. But of course, along the way, you see that is actually the phases that we go through. So I also feel that way. Wow, that few thousand is like something, it's an investment. So we don't dare to play with it. Now we also don't dare to play with it, but we have a different kind of how do I say different kind of the thinking, all right? Different kind of handling when it comes to this kind of emotion already, because things have actually changed and we have progressed along the way. Similar question to question number 1. If let's say your stock go up, right, how will you feel? So this one I believe that no need to put in the chat box also can, right? Everyone I suppose will feel so happy, right? I believe so lah. Okay, so of course, okay, so Jeffrey, thank you so much for your response. Of course, everyone feel high when the stock price go up, especially if let's say if you are into Top Glove and then why go up to $28, of course you feel so high, all right? You feel so like, woo, all right, on cloud 9 already. So that is actually the emotion. Actually, that emotion is very dangerous. You cannot be buying stock when you're on a high. Not a very good emotion to be in. Not the most productive. I wouldn't say the most productive emotion. When you feel like melompat, that is the time you have to stop and be grounded on the foot. All right. Make sure that your investment decisions, right, are grounded. Don't make decisions when you're melompat. All right. Not very helpful. Okay. So this is actually the emotion that you need to actually be wary about. And now maybe you guys can help me by listing down the emotions that you will feel if let's say the stock price that you have bought drop in stock price. Maybe you have bought Top Glove at the peak, $6, $7, $8, $28. Now it's $2. So how do you feel? So how do you feel if you're in that position? Rage. All right, rage means very angry. Joe Ng says stress. Marcus says happy because you can buy more. A little bit disappointed, angry, depressed, sad, stop, go to seaside to relax.
I think Marcus should have already had a game plan. Because maybe Marcus only bought, maybe Marcus plan to have 20% in the portfolio of that stock. Maybe Marcus just bought 2%. So when it drop more, Marcus is more happy because he can use the remaining 18% to buy more.
Yes. So I talk a little bit about emotion here is because just like badminton, you see, like when you are at the final stage, 20 all, 20, 20, 20, right? And then you need another 2 points to win, right? And then you are the one serving, you also feel very nervous, right? I mean to say, wow, everything at stake, right? 2020, and then you're serving. So this is actually one example. If sports, right? And then if sports, right, have to deal with emotion handling, right? What about investment, right? So this is actually something that you need to be on constant check.
Yeah. I if I may add, I think just now, Ian, you invite me to add my point of view, right?
Yes, of course.
Yeah, of course, when it comes to investing, the best state to be in is emotionless. Okay, when you can reach the state of emotionless when it comes to managing your investment, then you are, very close to mastery. Okay, so I'm, for a lack of a better word, So, because if you are feeling excitement and you are feeling depressed, right, based on the price volatility, or if you feel exciting when you invest in stock, actually you're not investing in stock, you're gambling. Okay, investing is supposed to be very boring, man. Okay, you buy, like what Ian Tai said, you buy a good company and then you wait for the price, the real value of the company reflect in the share price in the long term. So it's supposed to be a boring game. Okay, if you have excitement in investing, then you're not investing, you're gambling already. So so for whether you are traders or you're investor, right, it's supposed to be emotionless, because traders, right, when they make money, they are not professional trader. When they make money, they don't have, they don't feel, they are supposed to not to feel anything. Okay, if they lose money, they're not supposed to feel anything also. Okay, because if you make money, like, okay, I belanja you makan, okay, then you lose money, you also become very sad, right? Then it's not good. It's not a healthy development. Okay, so I think a good investor should aim for to reach the state where you are emotionless when it comes to managing your investment portfolio.
Rightfully said, lah. Actually, yes. Of course, all of us, because we're all human beings, so it's hard to be a robot, lah, because only a robot can be emotionless, right? Everyone is okay, including myself, lah. There's always a high, there's a high, there's a low. I believe what both of us we are talking about is actually to keep our emotions in check, to make sure that we know ourselves when it comes to the emotion, when it comes to emotional part. All right. Whenever you feel the emotion, right, please be in check with logic. Then you will make better decisions. All right. We talk about, so this is actually more like not to suppress your emotion, but you have to handle it better. Because every sports people, right? Of course, you can be a robot playing badminton, lah. every serve also jadi one, lah. But it won't happen, lah. Your hands still jitter, lah. But then you have to handle it better. Okay, you cannot show. You have to have a poker face, lah. When you face your opponent, you cannot tell your opponent that you're nervous, lah, when you are serving. So that's what we are trying to say. Okay, and because of this, right, what I will strongly emphasize is, if you are new, right, build a prototype portfolio. Okay, why prototype? Why this prototype? Why not go into expansion straight away? This is because it is at this stage you will learn about your emotion. You will learn how to handle your emotion better. Okay, you test out what you have learned. You put in some money that it's not going to affect your living expenses for the time being. Test out your strategy, but most importantly, it's not the return, win or lose. The most important thing is you know how to handle your emotion. All right, like for example, COVID-19, boom, crash your portfolio. How do you handle your emotion? When your stock price go up, how do you handle your emotion? All right, your stock price go anywhere, how you handle your emotion. That is the most important thing. That is the thing that help you to mature as an investor. All right, because if you think about it, right, some matured investors, right, they have been through all the ups and downs. US-China trade war, changes in political leadership, be in our country or globally. All right. Pandemic, oil price go up, oil price come down, ringgit go up, ringgit come down. Anything can happen in the market. How do we deal with our emotion? That is actually the thing that we need to focus on. Okay. If you keep that in check, you'll be a better investor. All right. So with that, I'll end with a summary. So here are some takeaways for all of us today, whether or not you're in the A group, B group, C group, or D group. Number one, successful investors think and do differently from most people. Compare, all right, compare and then adopt. So if you are new, you may want to learn from the successful investor and then you see which one is better, go for it. And if you're in the D class, which is anything above 100,000, of course, if you're in the 100,000 category or $200,000 category, you may also want to learn from people who have actually or they are experiencing managing a portfolio worth $500,000, maybe something a little bit closer to where you want to go. Then you learn and then you move up. Of course, if you're in a $500,000 category, of course, you want to learn from people who have 600, 700,000 or maybe $1 million, and then you learn from there. Okay, so keep in mind there's always a process of continuous learning. Second, if you are new, knowledge, learning, emotional handling, experience is more important than the investment returns and the results. The third one, my journey, I have gone through the 5 phases. I will still continue to go back from phase 1 to phase 5, 5 to 1, 1 to 5. All right. So make sure you understand there are phases. Don't just expect 0, boom, $1 million in no time. It doesn't happen. Okay. So investing is a lifestyle of learning, growing, and maturing. And finally, try not to take shortcuts. All right. Because normally people will take shortcuts. They don't live very long in their investment life. All right. So go through the phases slowly. Take your time. Especially for those of you who are young, take your time. The time is on your side. Okay. You don't need to rush into things. And with that, I would like to thank Shane for inviting me to actually offer offer a message. Here to offer a message of my own investment journey and my own investment insights to your audience. And perhaps we can actually do some Q&A. Shane.
Right. So if any question for Ian, please write in the Q&A box, then we will address them. Okay. So I already have a few questions on my screen.
Yep.
So the first question is, as a value investor, when the share price is falling and it's going to be lower and lower again, for example, like glove sectors, right? What is the best timing for value investor to top up the fund into this stock?
Actually, for glove stock, I really don't know. I mean to say it's a whole learning process for me, but I find something very interesting. All right. Most value investors, they buy glove stock before the pandemic one. It's not to say like exactly 2020, but they buy it like way back then, like a long time ago. Okay, so it's only when things got hot, then people talk about Top Glove, Hartalega, Supermax, Kosan, and all this kind of stuff. So the question is why we only talk about this stuff when things actually go along, right? So that is actually number one. The number two is that when it go down, then of course people feel very disappointed. But the question is, how do we value? What is the basis of our valuation of glove stock? Some people say, oh, glove stock, PE ratio very low. But the thing is that the PE ratio, the E, the earnings is calculated based on the latest 12 months. But the latest 12 months is what? Glove companies are making that much of money. So your question is, can all these glove companies, let's say they make, I don't know how many billions, let's say 5 billion or 7 billion. Last 12 months make 7 billion in net profit. Can they sustain this kind of profit forever? That's my question. So if can, then you value it based on 7 billion. If you think cannot, then then you have to find another way to value this kind of stock. All right. And if you happen to be like me who don't have an idea what might happen how to value this kind of stock with such an anomaly, wow, out of nowhere have a spike in profit. If you're not so confident, then pass. There's always another deal. Shane?
Okay, Marcus would like to ask, is it good to have 20 to 30 companies in our portfolio?
Okay, so when you're starting off, it depends, you see. That's why when you're starting off, when you're in a $50,000 category, if you're in a $100,000 category or $1 million category, it's going to be very different. Okay, so initially, I think you can start off with a watch list of 20 stocks, 20 of your choice. I'm speaking for those people who are in the A category. Start off with 20, and then from there, you can have a list of 5 stocks. 5 or 10 stocks, depending on your portfolios, depending on your portfolio size. Okay. Now, if you're in the, as you go along, you will tend to actually increase the number of stocks. Okay. So for those of you who are in the $100,000 category, it depends on the market that you go to. If you are in Malaysia, then of course you can have 10 to 20 stocks. If you're in overseas, then it's another thing. But let's stick to Bursa Malaysia because this webinar is brought to you by Bursa Malaysia, right? So if you're in Malaysia, then I will say 10 to 20 stocks, somewhere there. Or maybe you can have 6 to 10, 8, 10, something like that. And of course, if you have 200,000, then you have double digit, like maybe 15 to 20 stocks or 20 to 30 stocks and something like that. So the number will change in accordance to your portfolio size.
Okay, thank you so much, Ian.
Mm-hmm.
Raymond would like to ask, what is intrinsic value of a stock?
Intrinsic value is actually an estimated value, okay? And the formula to calculate intrinsic value, it contains some assumptions lah. All right, depending on what formula you use and the assumptions that you make. But the whole entire goal is to actually calculate an estimated value of the stock or that business. Okay, so if you find that the intrinsic value is, let's say, $50 and the stock price is $30, then you think that it's undervalued, then you go ahead and buy. If, let's say, for example, the intrinsic value of the stock is 50, but then the stock price is $100, you felt that it's too overpriced, too overvalued, then you don't buy. All right, so some people, they tend to calculate the intrinsic value first before they buy a stock because they want to know whether or not they are overpaying for the stock or whether they are actually getting a real discount.
Okay. Shafi would like to ask, when we achieve our target, should we liquidate our portfolio and use the money?
It depends on what is your target. So actually this one, it really depends on your own financial planning. But for most people, I would say for most investors, I think they will value businesses more than cash. All right. So even Warren Buffett, Charlie Munger say, what target are you talking about? You're like billionaire already, and then you're almost 100 years old. You still don't want to cash out. they still hold on to their businesses. So I mean to say, for them, right, they just value businesses over cash because they know that the businesses are producing cash and they have more cash to use for their entire life. So I don't think you need to, so I think it depends on how you invest also. If you invest for dividend income, most likely you won't cash out because you need the stocks to generate dividend income for you to fund your lifestyle, right? But if you're into capital gains and then most of the stocks don't pay much dividends, then of course you have to cash out. Then that is another strategy. But from the start, I think I have identified myself as a dividend guy. So most likely I won't cash out. Shane?
Okay. Pauline would like to ask, is it good to start investing globally as a newbie, or we start in Bursa first until we are confident to diversify?
Oh, that's a very good question. So the answer actually depends on your capital. So which means to say, for example, if let's say, for example, if you don't have much capital, then of course you have to start off with Bursa Malaysia, because with Bursa Malaysia you can buy some stocks, really good stocks at let's say at a much affordable at a much with a lower capital, I would say. Okay, with lower capital, you can buy some really good stocks. Okay, so which is very suitable for people who don't have much savings to begin with. But of course, if let's say you are starting off with some capital, of course you can actually go with you can actually go global if that is actually your objective. And if let's say your objective is to diversify your wealth away from the Malaysian ringgit, then of course then global will be your choice lah. But that depends on your objective. So is that your objective? So that is actually the question that you want to ask, right? So ultimately, right, it all depends on your objective. And number two, do you want to participate in the growth of Malaysia, or do you want to participate in the growth of other countries? And finally, number three, your capital, your affordability, which will affect your affordability. So these are the few things that you need to consider before you make your final decision.
Okay. The next question is, how long should I expect to go through the phases? Yeah.
Okay, so basically, if you are starting from fresh, right, you can actually start off with, you can actually take a few months to start off with phase number one, okay, to know what is the mindset that successful people adopt when it comes to investing, and your current beliefs, okay? So this one, actually this phase can take forever, but then just limit it to 2-3 months. Don't say, I know already, then say, okay, let's move on to phase two. It's not exactly that lah. You just need to know enough you just need to know the gist of, oh, okay, so this is actually the philosophy that successful investors are taking when it comes, this is how they think when it comes to stock investing. Then I think it's more or less good enough to move on to phase number two. Because if you stay at phase one forever, you might not even want to invest. So just take a few months for each phase lah. All right. So you can say 3 months for first phase, 3 months for this, maybe 3 months to learn about financial statements, another 3 months to learn about valuation, and then build a prototype in another 3 months. So 1 year lah. 1 year you can actually go into phase 3 already, and then after that, the second year, the first of the 3 months is for you to optimize. You can actually get there. You can actually go from phase 1 to phase 5 in 18 months, 12 to 18 months, depending on your speed of learning.
Okay, I think most importantly for new investor is don't give up lah. There's learning curve, there's a learning curve in the market. So if you face drawdown period or losses period, don't give up. Take it as a stepping stone for you to learn from your mistakes. Okay, so next time you'll become better. Okay, so like what one of my teachers or mentors, Warren Mark, say that if it's going to take a few years for you to get a degree, what do you think that you become rich in 3 to 4 days in the stock market? Yeah, so it might take a few years for you to learn a lot of things in the stock market. So yeah, so we have to go through phases.
Yep. So don't give up just because you lose to Momota. Keep playing, yeah.
So the next question by Shafi Saleh: should we diversify or should we do focus investing?
Okay, so it depends on what to diversify and what to focus. Okay, from my own self, right? I focus when it comes to my plan. I focus when it comes to my strategy, which is dividend investing. All right, so which means to say I focus on that objective, on that plan. I focus on my system, on identifying good businesses and avoiding bad businesses. I focus on my valuation. So that is actually the things that I focus. All right. I don't diversify on strategies. You won't find me doing dividend investing on one hand and doing trading on another hand. I don't do that. So there is certain things that I focus. Plan, strategy, objective, system, focus, diversify. But these are the stuff that I diversify. I can diversify into stocks, into different industries. I can diversify into stocks into, let's say, different countries. let's say if you want to go global, you can diversify in terms of countries if you want to. If not, it's okay. Just focus on diversification on industries. Okay. And then you diversify in terms of the number of stocks. So these are the stuff that I diversify, but I have a focused strategy. Shane.
Okay, understand your point of view.
Mm.
Joe would like to ask, what is your recommended average lot price a new investor should buy for the first time they buy a new stock? Is it 1,000, 3,000, 5,000?
Okay, so this one, it really depends because I do not know the people's earning power. Okay, it depends on your earning power and it depends on what is more comfortable for you. And I see in the question, a new investor to start trading. So your first homework is to understand the difference between what is investing and what is trading. Is trading investing, or is investing trading? Or is there a difference between the two? So you have to split. Most people hard to do these two. Okay, like me, for example, I'm better off investing and forget about trading. All right, so I prefer to have a focused strategy when it comes to that. But you may want to understand the two. But back to your question, 1,000, 3,000, 5,000 depends on your earnings power. And it depends on your experience and it depends on your emotional handling. So if you are more experienced and you think that you can go more, then why not? I don't know. But it will be not so smart if you say, I have no experience, I just want to hantam 5,000 into the stock market because I can. Then you're just playing a fool, all right? So why not just start with something that is comfortable, build a small little machine that is working first, then only you upgrade your machine to a bigger machine, which is your stock portfolio. Okay?
Okay, what type of stock should new investors focus on? Is it growth stock or dividend stock?
First and foremost, I would like to say, when people think about growth stock, remember just now I asked the question, do you expect the growth stock to actually just do you expect the growth stock to just boom like that? The question is this, okay? So the question is this, what is a growth stock? You have to understand what is a growth stock and what is a dividend stock. To me, from an investor point of view, all right, both stocks must, growth or dividend, both stocks must be fundamentally good. But there's a subset. So you have a fundamentally good stock, then we have categories, growth or dividend. So growth stocks are stocks that prefer to use their earnings to grow the business. Dividend stocks are businesses that are good cash flow. They take the cash, they prefer to reward shareholders with dividends than to continue to grow the business. So it depends on the usage of the cash, the usage of the earnings, to me, all right? Both are good companies. So once again, good companies, the differences is how they use the cash and profit. One prefers to grow the company, the other prefers to reward shareholders with dividends. So if you're into growth stock, you need to understand what the company is doing to grow the business. Then it makes sense. Then you build a strategy from there if you're into growth stocks or growth investing. If you're into dividends, then of course you can do the same, but you have a more focus on dividend income. Okay. But if you want to get your first few dollars from investing, you want to build your confidence, you can start off with dividends, all right? Because it's easier to see the outcome from there, all right? But I will add on one more point. Dividend investing is actually very easy for people to build confidence, all right? It's like a fight. Let's say, for example, in a boxing ring, right? Dividend is a bit like, okay, you just throw your jab, you just throw a cross, and then you punch, all right? You score points. That's dividend. Growth is like knockout blow, okay? So you don't always try to aim for knockout blow one. It doesn't work, All right. You start off with all the jabs, the cross, you hurt all the body shot first. Make sure that the opponent is disarmed already. Then only you go. Then when you feel more confident, then you just go for the kill lah. You go for the group stock lah, knockout lah. But don't go in like wow, you are some champion, first group stock, want to knock out people straight away. Don't know. that is from the boxing point of view lah.
Okay, thank you so much, Ian, for enlightening us with examples from badminton and also boxing. So today we not only learn investing, but we also learn in the context of analogy in terms of badminton and also boxing. Thank you so much, Ian. Let me go to share my screen. Yeah, so we have come to the end of this session. So thank you so much for joining this segment.